First off, I just want to say a quick thank you to everyone taking the time to be here. I know everyone is really busy and there's a lot of different ways that you could spend the next hour. So I'm not going to take that lightly. We're going to cover a lot of information today. But we're going to mainly talk about something that I think everybody feels, but may not necessarily know how to articulate. Most people, they're doing absolutely everything right. They're doing everything that they were told to do. They're working hard, saving consistently, investing in the stock market. They've got a 401k. And on paper, everything looks right. Everything's going well. But then that underlying question always comes up when we're speaking to investors is it enough? Is my money actually working for me today? And that's really what it comes down to. This is not going to be a conversation about working harder or about saving more. It's definitely not going to be about chasing risky strategies. It's really just about understanding the difference between building wealth on paper and building income that you can actually use in your life. So some introductions. I'm Lindsay Davis, CEO and co-founder of Spartan Invest. And I can think of no one better to help walk us through the differences between real estate investments and the traditional 401k path than Miss Maureen McCann, who is joining us from Southern California. She is also a co-founder of Spartan Invest and a wealth strategist for hundreds of investors. And she's been in the business for 20 years, just a plethora of knowledge and experience. Thank you so much, Maureen, for jumping on with us today.
Girl, I wouldn't miss the opportunity to hang out with you and everyone else. So here I am. Let's rock and roll. Let's do this.
Absolutely. So I'm going to turn it over to you. We're going to walk through some basic comparisons, and I'll just let you kind of take it from here on what all we're going to discuss today. And I'll chime in. If anybody has questions or comments, please put them in the comment section. I will try to get to them. And if we cannot, if I don't get to them throughout the slides, I'll definitely revisit when we wrap after about 45 minutes or so. All right, Maureen, I'm going to let you take it away.
Awesome. I will do. And before I get started, though, I just want to give a big shout out to all of you that are here and are learning and are raising their hand to say, hey, I want to know if there's a different way of doing things, and will it benefit you, right? Will it benefit you and your families in the long term? And before we jumped on the call, I just want to say, behind the scenes, we were talking about the number of people that have actually registered to be on this. I mean, we're excited, right? We're super excited because there's so many. But I was like, Lindsay, why is there so many people, coming in and tuning into this workshop? And we think maybe it's just because there's a lot of, it's necessary. You guys are really seeking for something new, and we really hope to deliver that today for you. So with that, let's jump right on in. So, okay, what is something that possibly could be a problem that maybe we were programmed, I want to say erroneously, but it probably worked in the past. But those strategies that we were taught before may not necessarily, those that were taught decades ago, are they relevant today, right? Or do we need a little adjustment, right? Like a chiropractor, we just need to adjust our little financial backbone. And so here is what we've been taught that may not necessarily be 100% true today, right? So we've been taught, invest consistently, take 10% of your income and set it aside for a rainy day. Number two, diversify your portfolio. What does that mean? Diversify into what, right? We have so many more options now than we did decades ago. So how do you decide which option to choose to diversify into? And then this one kills me. Let's just, do all this hard work for decades and decades and decades, not enjoy any of it until the very, very end of your life, right? I don't know if that really sounds really fun for me, not necessarily. And you know what? If Jesse might be behind the scenes and do this, but I don't want to be the couple that shows up in, many of you guys have seen it, it's the couple that's sleeping in, they're the elderly couple, they're sleeping in a gondola, going down the canals of Venice. I'm like, I want to be awake. I want to see the world. I want to travel and be able-bodied and do it when I'm not 80, right? I want to do it younger, sooner. So That's what we've been taught, right? What that actually creates. Well, okay, over time, we're going to see our account balances grow. We love that. Thumbs up on that, right? But then we're going to see a delayed access to our wealth. What do I mean by that? It means we're creating wealth, but we can't touch it. And why can't we touch it? Because it's in, I like to call it, prison. It's in government controlled accounts that we cannot touch. We're told, you can put your money in, but you can't take it out. And if you take it out, guess what's going to happen? We want our fees and penalties. And by the way, it's going to show up as ordinary income that year in your taxes, and you're going to have to pay more tax on it, right? So it's delayed because we can't really touch it. Not really fun, right? All right. And then the last one is it's exposure to the market timing. There's a lot of volatility, and the longer you're in it, the more exposed you are. So what we're going to show you guys today is this. We're going to show you the difference between net worth, and we all want a big number, right, for the net worth, but who wants net worth without monthly income or cash flow? I want both, right? How do we get both? That's how the rich think. It's not one or the other. It's how do I get both? Why timing matters more than the average return. We're going to look at that. It's really important. And then how to build investments that pay you along the way, right? It's no secret, guys. We are a turnkey investment company. We help investors build real estate portfolios, single families, one at a time. So are we going to show you how real estate can do this for you? Yes, we are. So strap in. Let's go. So what most people don't see, you guys, is this, and this is so important, is that you can, over decades, really build a significant amount of wealth. But is that wealth producing monthly income every single month for you? You might have a really pretty portfolio, really nice number, $2 million net worth, but how much cash flow do you have, right? And how much time do you have?
Absolutely. And going back to, using it when you retire, one of the things that you always talk about with your clients, Maureen, is just how much time they actually have. How much time they actually have to do the things that they want to do. And this how we spend our time is so powerful.
Oh my gosh. When I saw this for the first time, I was like, whoa. And I'm sure a lot of the guys that are listening or watching, tuning in, you've seen this too. This is not a big deal, but it's probably a good reminder for you guys right now. Think about this. What you guys are looking at is these dots on the screen represent an adult life in months, right? From 18, that's when we become adults, to let's assume a life expectancy of 90. So these are all your little dots, right? How do we use our time? Well, the majority of time, we've got 300 months for sleeping. Brain needs rest. 140 months working. 140 months screen time, which that is terrible, but it's probably reality. Right. And you can see the rest. 90 months social, restaurants, socializing with friends, 70 months eating, 60 months chores, 50 months commuting, 30 months taking care of your health. Right. What does that leave us left? Right. 233 months. Someone take 233 months, divide it by 12 months. I'm going to already tell you the answer is it's 19 years. Right. And Lindsay, fortunately, she's younger than me. So she probably has a longer runway for her wealth building and cash flow generating strategies. I'm a little bit I'm 15 years ahead of her, right? So I have less dots to do stuff with. So it's really important to think about, you guys, how you spend your time, who you spend your time with, because we are the sum total of the 5 closest people we hang out with. So hang out with really smart, intelligent people that are generating cash flow and income. And then it also matters where you park your money.
Yeah.
This is huge. Okay.
And when you look at 219 years in your adult life, from 18 to 90, you have 19 years to do what you want to do. When you put it in those terms, it is definitely eye-opening. And I think that, I think it changes really how you see everything. But then also when you're building wealth, you're putting it in terms of like, well, someday I'm going to build wealth versus income that you can actually use in your lifetime. And what is scary is that a lot of people do not realize that the traditional path to build wealth, the 401k, the trap, as you called it, is still relatively new.
Oh yeah, this was, I mean, I think about this because I was born in 1970, right? And I didn't start, I mean, I had my first paper
Mm.
out at 8 years old, but there was no retirement count for a paper delivery person, right? But as I got into I started getting my working years, my teenage years, I started hearing about this thing called the 401k. And I was like, oh, and it was really sold to me as, and I think to the masses as, this is like your end all be all. You just put your money in, you get your 6% company match. You're going to get your 8% consistent year over year rate of return on that money. And so by the time you're ready to retire, you've got millions sitting in this account. And that is what I thought to be true, which I am sure many of you on this call believed it to be true as well. And I can assert that the majority of the people that I speak with since over the last 19 years has been 40 to 60-year-olds. And guess what? It's because we're all waking up going, I don't really think that investment strategy that I was taught years ago actually is working out. So maybe I need to look at something different, like an alternative route, which is we're going to look at. So, just a little history. The 401k was started by Ted Benna, by the way, who was a benefits consultant for Johnson Companies. Just so you know, he wasn't some big economist. He was a benefits consultant, and he did research on the code, the Revenue Act of 1978. He implemented it in his company in 1981, just as a supplemental plan. And guess what, guys? It was sold as a primary plan. And here's the biggest difference. What came before was pensions. I would have loved a pension where you gave service, gave 25 years to a company. They gave you your salary indefinitely till the day you died, right? That became too expensive. And guess what? The savings that went from the corporate doing the savings for you, or the corporation doing the savings for you, now because they took all the risk, now guess what we have to do? The consumer, we have to self-fund our retirements and have the discipline to do it. And I can show you that, not in this another time, but I can show you that saving does not get you the wealth you want. Investing does. You cannot save your way to wealth. You have to invest your way to wealth. And today you've got 60 plus Americans that rely on 401ks and Social Security. And that's pretty sad when you think about the average money, the amount of money that is in a 401k. Now it's broken out in age brackets, right? But it's about 70,000. And if you're a little bit older, it could go up to 250,000. And if you take 250,000 divided by $5,000 a month, you're looking at 3 years. That's all you got in retirement money. That's not going to last.
Absolutely not. Absolutely not. And then comparing the 401k as a supplemental plan to real estate, to rental properties.
Well, then let's go back in time, right? So when did rental properties where did the concept even start with? Well, we got to give credit to the Romans, the ancient Romans, right? One of the biggest dynasties that ever walked the planet. So they were the first to structure rental housing. Thank you, Romans. I love your food too, by the way. Land ownership, right? Love Italian food. Land ownership has been historically one of the primary ways you build wealth, right? Why was there fiefdoms, and why was there, prominent families marrying each other? Because they wanted, what did they want? The land. They wanted more land, right? Because it builds what? More wealth, right? Nothing has changed. There is the old way of doing things, own the land. There was the new way of doing things, the cheap 401k plan. Let's go back to what works from time ago. So in the United States, rental house became available in the early 1700s, post-World War II, massive amounts of housing demand there. Look at the modern real estate investing world today, from the 1970s to 80s, which sounds so old, especially when my kids were born in the 2000s. They're like, when were you born, Mom? I'm like, 1970.
I know they're really mean with that. They're really rude.
I hate it. I get it. I get it. But it became, the opportunity to invest in real estate really became available to us in the 70s and 80s. We had tax advantages where depreciation was available to us. Financing became available, giving us even more opportunity to invest in real estate. And then historically, if you just look at long-term trends, real estate outperforms inflation. Real estate outperforms the market. It grows. This data here says 3 to 5% based on market. I saw another data point that real estate grows at 5.5% year over year, whereas inflation is 3.5% year over year. So if you just have money in savings, inflation is eroding that. faster than you've got real estate that's building on top of it and accelerating it. So real estate is absolutely the way to go if you want wealth and cash flow.
And real estate is not new in a trendy new like fad, like cryptocurrency or anything. Like you literally have centuries of data and proof that this is a reliable path for investment and wealth growing. So, you know, we feel like we know that, and we can look to history to justify that. But what I want to spend the bulk of today is looking at, like, let's say we'll call it the tale of two investors, right? Like, let's take two humans and put them in the exact same scenario, same consistency with investing and saving, same, you know, same money, same revenue, all of those same things, just completely different paths, and walk through what that looks like. And you can name your little gray and green men or whatever, you know, move them through these different paths.
Definitely. Yeah. So I love the tale of two investors, right? Here we go, guys. And I want you to ask yourselves now at the very end of the seminar or what is this thing called? Workshop. At the end of this workshop, you guys, I want you to just ask yourself and answer the question, do you want to be the gray guy or the green guy, right? And let's go see which path works out, right? Because they're both going to get to a destination. Just one destinations might be more attractive to you than the other. So let's take a look at it, right? All right. So everything is the same. These guys are gray guy and green guy. Started investing, saving $10,000 a year, right? That's what they're doing. Gray guy, he's taking the traditional route. He's going to go, okay, $10,000. I'm going to put it in the market. I'm going to earn my average return of 8%, which probably inflation adjusted is 6%, but I'll just leave it at 8% for this example, right? Okay. And the time horizon for him to collect on his investing strategy, 35 years. So over that 35-year period, at $10,000 a year, he contributed, gray guy, contributed $350,000, right? His growth, the compound interest, did all the heavy lifting for him. He just chilled, did whatever. He's probably playing Candy Crush or something. I don't know. And then you have, and so he waits, right? Here's what gray guy gets. He gets no monthly income, zero. He's got a nice portfolio valuation of 1.72. He has no monthly income, zero cash flow, nada. His portfolio can fluctuate with the market fluctuations. So volatility there, lack of control there. And then guess what? If gray guy wants to withdraw his money prior to the allowable time, he's got to pay a penalty and fine to Uncle Sam, which is pretty hefty. So limited in what he can do. Alternatively, let's do what the Romans did, right? Let's take a look at what they did. So here's green guy. He's saving $10,000 a year. He gets to year 5, and he's got enough to buy his first rental property. Brand new construction, $200,000 house, 25% down. There's his $50,000. What does his $50,000 investment yield him nearly immediately? $250 a month in cash flow. Now, that does not sound sexy to some of you. I know. They're like, I want $2,500 a month. I get it. But we start where we start. Because guess what? This is long-term buy and hold. This is not short, accelerated, grow, be a millionaire in 12 months. No, it's a 35-year plan. Here's how you do it, right? So you're $250 a month, $3,000 a year. If you're saving $10,000 and now you're getting $3,000 from your one rental property, that's $13,000 for the year. Now, how do we take that money and accelerate and scale your real estate portfolio? Here's how you do it. I'm going to give Lindsay credit because she did this math. I did not. All right. So time to purchase your second property, because I get this question all the time. Maureen, how do I do this? How do I scale? I heard about this. I want 10 properties or 15 properties, or some people are like, I want 100 doors, but I don't even know where to start with number one. How do I do this? Here's how you do it, guys. No, math does not lie, right? People lie. Math does not lie. And facts don't care about your feelings. So just listen, because this is truth. This is the truth bomb. Here we go. So if you need $50,000 to buy your second and you've got $13,000 coming in annually, right? So you take your 50,000 divided by the capital that you have, that's going to take you 3.8 years to get to that 50,000, right? Didn't take you 5 years like it did the first time, took you 3.8 years the second time, right? So that cuts your timeline down. Oh, we're starting to accelerate this, right? After 2 properties, now you've got your second property. They both generate $3,000 annually. That's $6,000 for the year. You've been saving your 10,000. So you take your 10,000 that you saved, your 6,000 that you got from your 2 rental properties that are giving you what? Cash flow. And now you've got $16,000 a year. So what do we do if we need another $50,000 down payment for property number 3? We take the 50,000 divided by the 16,000 that we have annual in cash. That shortens the acquisition for the 3rd property to 3.1 years. And we just keep rocking and rolling, right? The snowball effect. So how you turn one property into a real estate portfolio is slowly over time, with discipline, execution, with the team that supports your goal, because we want that for you too. And then this is what you get, right? Salary savings, you're still saving $10,000 a year. Your first investment property, $200K, down payment, $50,000, cash flow, $250 or $3,000 a year. Look at this table, right? We've got property column 1 through 5, annual cash flow 0 through 15,000, total annual savings. Remember, you're saving $10,000 a year, or green guy is, right? Green guy's saving $10,000 a year, but from his properties, his annual savings year 2 is 13, year 3 is 16, year 4 is 19,000, year 5 is 25,000. Guess what gray guy's getting? Zero. Right? That's important. So then you can just see the time to buy, your time to acquisition timeline gets shorter and shorter. The more properties you have, the more cash flow you generate, the more that you save in combination with the cash flow. Now you guys, and Lindsay, I'm going to let you say that line because that was your line and it's freaking good. The one that's highlighted there, your first property. It's
yeah, your first property, it doesn't change your life. And you touched on this, is that the $250 a month, that's not sexy. That's not, like that's not the goal, right? You would not take $50,000 and stick it in your 401k and be done with it. You would, you wouldn't do that over 5 years and then let it go and be like, well, wait a minute, how am I not prepared for retirement? Because that $250, yes, that is going to accumulate. And something that's also extremely beneficial to keep in mind, but we did not do it for this example, is we did not even factor in all of the additional things. I think it's worth noting, but this is buying one property and saving the cash flow that you're able to get for it towards purchasing additional properties. And so it takes you from 25 years to 30 years. It's going to take you that 5 years to buy that first one, and then less than 4, then 3, then 2.6, and then 2. So you have been able to save the exact same amount and purchase 5 properties by the time, like, let's say you bought your first one at 30, you can do this one at 41. But we are not even factoring in rental increases, right? This is the same cash flow. We calculated the exact same cash flow for all of these properties. And that's on the low end. Right? Because if you buy that property at 30, do you think that when you're 40, that property is going to rent for exactly the same amount? Absolutely not. No,
right.
It's not. But we're not factoring that in, right? We are looking at the same thing. We're doing our 2 investors, and we're saying, okay, this is the money that we're putting in. This is how we are applying it in a real estate path versus this is how that we're applying it in the traditional path. But another thing that we are going to dive into is, if you take this and you're not seeing what's happening in the background, you're not seeing that these loans are also being paid down by your tenant, which is another amazing thing to take into consideration, is that in the background, you are renting this property and that income is also paying down your asset. So what happens when you accelerate your principal pay down? What happens when you start taking that money I'm gonna let you walk through this, because this is also extremely powerful.
Yeah, and you know what? I'm just gonna be completely honest with you guys and transparent. When I first started 19, 20 years ago, I didn't even know what the word amortization meant. I didn't even know what, the principal reduction was, not to the degree that I know now. And so and that is such an underrated, powerful wealth driver for real estate investors. And very simply, you guys know it, right? Take out a loan, you have a starting debt balance. Every single year, that balance is paid down. That principal is paid down by the renter, not necessarily you. It may be you on occasion when you've got a vacancy, right? Because you have to make that payment yourself. But for the majority, that is someone else paying down your principal balance month after month after month. And that rate of return every year compounds year after year after year. It is it's not the powerful wealth driver, that's appreciation, but it really comes darn close as in the top 4 as one of the economic wealth drivers in real estate. So here's what happens, right? You have done a very disciplined job, and you have created and built a real estate portfolio. You are now up to 5 properties, generating $250 a month. It doesn't sound sexy, but when you multiply that 250 by 5, now we're in the thousands, right? $1,250 a month. Now you have a choice of what you could do with that money, right? We're still saving, right? But we've got the $15,000 for the year. Now we have an option. We could accelerate the pay down on the principal, or you can go buy a boat. I wouldn't recommend that, right? That's a liability. We want more assets in our asset column, less liabilities in our liability column. And if you have more assets and less liabilities, guess what you are building? You are separating yourself into that 1% echelon, and we want that for you. So here's what this breaks down to, right? Now, I love Lindsay because she's like, well, let's just start the investor at 30. It's like, well, some of us are about 30. Some of us are a little older, but I like her timeline. So I'm going to stick with it. I'll appease her, right? Okay. So you bought your first property at 30 years old, and now you're 41, 11 years later, right? So here at 30, your first property, someone has paid down 11 years of your principal for you. On your second property, you bought at age 33.8, if we're following that schedule, the acquisition schedule, right? So that means another renter has paid down your principal for 7 years. You bought your third property at 36.9 years of age, and that property the principals have paid down on that property for 4 years. You bought your fourth at 39, the principals paid down at 2 years, and then you just bought a new property at 41, right? It's brand spanking new. Don't have anything paid down on it yet because you just closed on it today, right? So let's look at the remaining debt balance in that same time period for each of those properties. I'm not going to go through each number, but you can add up, properties 1 through 5. And if you look at the debt remaining is almost 700,000, right? And I don't want you to focus on that number, because what I really don't want you to focus on, what's the worth, what's the total value of the real estate portfolio that you own? It's $1 million, right? And the 700,000 of debt has got you $1 million worth of real estate, and someone else is paying all the bills and giving.
Right. And again, I didn't mean to cut you off, but that $1 million is just 200,000. That's just the purchase price, right? Again, we're still not even factoring in the appreciation. We'll look at it on the next slide, on a couple of next slides, but you only owe 700,000 on these 5 properties with a portfolio worth of $1 million, right? But that's what you purchased it for. But everybody knows that that real estate will continue to increase in value. So again, just for simple math, we're not factoring that in. Sorry.
I love that. That was a good point. Yeah. And if you look at the last 75 years of a U.S. home price appreciation, some years it's single digit, other years is double digit. There was only one period of time, I think you guys know, if you're old enough, you've heard of the global financial meltdown, right, of 07 to 11. That was the only time that real estate lost value. every single year consistently. Other than that, you have not seen it in 74 years. Hasn't happened. Hasn't happened, right? If you want history on your side and you want consistency, real estate appreciation, capital growth is undisputed. It's undisputed. All right. So what do we do to accelerate now this is where I really want you guys to get this, right? Because this is the big difference between green guy, gray guy. Green guy. We like green. Green's money, right? Okay. So what happens to your income, right? Once the properties are paid off, and in what timeline? We'll show that to you. So when you finally get rid of the mortgage, pay all the mortgages off, or not you, the renter does, right? Now you're $250 a month in cash flow. Mortgage is gone. Don't have to make that payment anymore. That money's coming to you. So now we're at $1,100 per property. 5 properties times $1,100. We're looking at $5,500 a month. Who would not love just waking up, getting mailbox money, $5,500 a month? I would love it. I think it'd be fantastic, right? I would like 15,000, 25,000. I mean, the bigger, the better, right? But here's the thing. What Green Guy did over a period of time, building a portfolio of rare properties, and not even like just 5 of them, right? Gets him to this, gets Green Guy to $66,000 of annual income generated passively. He's doing nothing. Green Guy's doing nothing for it. He did all the work for it before. Renter paid everything off. Now it's time to collect, right? Okay, so let's recap. Here we go. So we've got 5 properties at $200,000 a piece, at 25% down. That's the acquisition strategy. Total initial portfolio valued at $1 million. Again, not accounting for any appreciation, any rent increases, just snapshot of moment today, right? Time horizon, 30 years. So from years 30 to 60, this is your game plan. And you discipline, you execute it well. Your properties appreciate. So you take 200% a year. Sorry, 2% a year, not 200%. That would be fantastic. Everybody would be buying real estate then. Right. So your appreciation.
But 2% is modest, right? Like you said at the beginning, again, we didn't want this to necessarily be, unattainable, right? We wanted it to be much more on the lower side, which is why we didn't factor in what your tax deductions. It's why we didn't factor in the rent increases on the cash flow. It's why we are only saying like, hey, so you've paid off all of your properties at 60. Now let's look at what they're worth, because now you're 60 years old. You took all of that cash flow after you after you purchased your 5th one, after you bought that 5th property, you started applying all of that income towards the principal. They're all paid off at 50. Now, again, that's also not factoring in the $10,000 that you are still buying. This is the money that you are making from your 5 properties. You are taking all of that and applying it to your principal. And so you would have that paid for by the age of 60. Factoring in a very low 2% appreciation, that puts your portfolio at what?
At 1.8. But I actually want to say one thing, because what you said was really important. I know when I've listened to webinars like this before, been at workshops like this before, and people just throw numbers at me, and I'm like, but show me. Like I am a show me type of person, because I'm like, there's a little part of me that's like, I don't know if I believe that. I mean, yeah, they look like they're innocent faces. They probably wouldn't lie to us. But the thing is, I encourage you guys, if you actually want to see how this works in an amortization table, I will show it to you. You can schedule a call. It's at that very end. You can schedule a call with me or Danny or anyone else on our team, and we can actually walk you through what this actually looks like. Because what did I say before? People lie, numbers don't. Right? And I will show you that I'm not lying, because the numbers will show you that I'm telling the truth. Okay. All right. So, gray guy, right? If you took the traditional path and you did, everything was the same. You would save $10,000 a year. You invested in different things. You had the same mindset, the same energy, right? The only difference is gray guy chose the traditional route. Green guy chose the alternative route. Gray guy, he winds up with a portfolio at the age of 60 valued at 1.7 and some change. But here's what he doesn't have compared to green guy. He has no income. He looks pretty good on paper, looks sexy on paper. I'd be like, oh, I'll date you, right? But right, it's great on paper, but no cash flow. That value can fluctuate, right? It could go up or down depending on the market. And then if he wants to take that money out, he's 59. I guess he's 60. I guess he wouldn't be any penalties. But if you wanted to take it out before, there's some penalties and fines, right? So your wealth exists, but you can't spend it without shrinking it, right? That it shrinks as you use it. It goes down. Guess what? Green guy's different. Took a different strategy, has a different result. So let's just do a side-by-side comparison. Portfolio value, gray guy 401, green guy real estate. Not much difference. 1.7, 1.8. Here's where the real rubber meets the road. Monthly income for gray guy, 0. 5,500 for real estate guy. Annual income for 401k guy, 0. $66,000, green guy. Debt, 0 for both of them. Control, 401, none. You're at the whims of the market. You're at the whims of the government telling you what you can and cannot do with your money. It's basically your money's in prison. You've imprisoned your money. It's trapped, right? And then with real estate, the control is higher. You can sell it. You can move into it. You can short-term rental it. You can do whatever the heck you want with it, right? You have more control. So you guys, there's the tale of two investors, and you have to decide. And I appreciate you guys being here, right? Because there's so many of you that were like, wow, what is going on? And so maybe this is something that you're really seeking and really wanting. And maybe now is the time that it makes sense if you're hearing it from us, because I know you've heard this before. We're not making this up on our own. We're not the OGs of this information. We're just, presenting it in our own way with our 40 years of combined experience, and encouraging investors to, hey, you've got a choice, gray guy or green guy. Who do you want to choose to be?
Well, and I think that, here we go back for a second. And I think that when you're looking at the two different paths too, because like we're doing the same thing. It was the same amount of money. They both started at 25, but then you also have to assess the risk. And when there are risks that come with real estate, and we will definitely get into that, but what are the risks with going the traditional 401k path? And I'm going to turn it over to you to walk through that. But one of the things that has stuck with me since I was very early in my professional career, I graduated from college at the end of 2007 and joined the workforce, started my corporate job January of 2008. It was terrible. It was an awful time. I was very lucky that I was able to secure a job, because a lot of people that I was graduating with or that graduated shortly after me struggled for a long time to find employment. So I was very fortunate that I was able to, and with a good company. But what I saw firsthand in those years, and it's in my core beliefs, is that I saw so many people, because it was Cintas Corporation. It's a great company, been around for decades and decades. And so many employees were at that time that they were getting ready to retire. It was a massive corporation. And I worked with dozens of employees that were at that cusp and they wanted to retire. And then 2008, 2009 hit, and that's paused. And I saw and worked with several people that had retirement parties planned and everything, and had to stay in employment for several more years. And so I think that that's also, and again, like I said, we'll talk about the real estate risk, because there are some, but I think that is such a crucial risk when you're looking and evaluating the two different strategies, or the two different tale of investors on what happens in the market. Like, what happens if you're 30 and the market crashes? Well, you got plenty of time to recover. If you were 64 and the market crashes and you're retiring at 65, it's a completely different story. So I'm going to turn it back to you and let you kind of walk through like what that looks like in a downturn, in a recession.
Yeah. And I love that you teed it up that way. And I love that you shared a personal story very briefly.
It was very impactful, right? Because I got to, here I'm 22 years old and speaking to all of these people that are wanting to retire and can't. And it's just really stuck with me.
Yeah, and I would say similarly, didn't happen to me personally, but it happened to my parents. And they were getting set to retire, market takes a dip, and I watched them. They had to make a decision: do they continue working, which they didn't want to do, or live off less? Right? My dad continued working a little bit longer, and then they eventually wound up living off of less. And that's not like the pretty insurance picture that retirement, those companies show you about. This is, you're going to be a spouse walking hand in hand on the beach and sipping martinis, right? That's the image that they created, but how to get there safely, right? Because there are some pitfalls, and I looked this up actually before we got on here. Was there are recessionary periods, and in the last 50 years we've had 6 significant recessions. The longest one being the Great Recession, which was 2008 to 2011. We all know what happened there. Hopefully, if you're young, go watch The Big Short. You'll figure it out what happened, right? And then the shortest one was COVID-19. Unpredictable. I think Michael Berry, he predicted the housing market, right? But the majority of us, there's no crystal ball. All of our crystal balls are broken. We don't know what's happening, but we have to be prepared, right? So let's take a look at what happens if the market drops at the wrong time. Because guess what? We don't have control over that, but we have to survive it, navigate it, protect ourselves and our assets through it, right? So we're going to take this scenario. We got the global financial crisis, 2008, like I mentioned, the Great Recession. You're 65 years of age. You've got a portfolio of 1.5. It feels good. Feels really good. All of a sudden, dun, 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 right? Market drops 35%, and you just see $500,000 of your 1.5 disappear. And you're 65 going, what am I going to do? How am I going to make that up? Right? And if you think about the hidden problem is time here, is the time is not working on their side. It's working against, the older we are, it's working against us. And so it took 4 to 6 years that people had to delay their retirement. Could you imagine we've seen these people. We've seen these baristas and Walmart greeters. Did they want to be doing that? No, but they didn't have that. They might have gotten the right financial education, but they didn't apply it, or they didn't seek it out, right? Or it wasn't painful enough because that's all they ever knew all the time. Like, I don't know how people get to where they're at, but we're trying to help you not go in that direction, right? Redirect to green guy direction. So the full recovery, it took time, right?
Yeah, absolutely. I mean, you weren't able to really, so if it happened when you were 65, you weren't able to get back to that 1.5 until you were 71. And if you had to have that 1.5 to retire, that was 6 years that you lost. And then, like, looking at that comparatively speaking, because the 2007 to 9 global financial crisis was a real estate downturn. It was led and initiated by real estate. And so I know that we talk about that and we get asked that. I know I get asked that a lot. It's like, well, what do you do in a recession? What happens? Because in 2007 to 9, real estate agents, home builders, they fled the industry because it was dead. Foreclosures were up to 35% in some areas, and for some of those quarters. So what do you mean real estate's not affected? But it's different when you're looking at rental properties. How do downturns affect rentals?
Couldn't have been a better tee up. My gosh, girl, you're just like setting up the volley. So here's what Lindsay's talking about. So if you were a homeowner at that time, that hurt, right? Especially if you over leveraged yourself. So then, and maybe your kids even saw that happen to you. They're like, that happened to my parents. I'm like, oh, I don't want to go into real estate. That's a terrible way to go. That's if you owned it and over leveraged yourself and got into that predatory lending debacle all from that time. But what if you were a landlord during that same time? It's a very different outcome, right?
Absolutely.
So I'm going to let you were good with the numbers. You roll it out, girl, because that was good.
Well, it's just, so let's say that it's, real estate shelter, just in general, on your basic hierarchy of needs, shelter is on there. So there is always a need for it. It is always a necessity. So if you were to purchase a property, even if you over leveraged yourself, if you were to purchase a rental property in 2005, and let's say you rented it for $1,000, when 2008, 2009 comes around, you're still going to be able to rent that property. You may have to rent it for $900, or you may even have to rent it for $800. But I guarantee you, you're probably going to still be able to cover the mortgage and the interest and the taxes. You may not cash flow that year, but you're going to break even and you're going to still be able to cover your cost. But that doesn't, like you said, that doesn't necessarily happen if you are owning the property and you're over leveraged. And so if you, that same property that you bought before the recession, it was still able to generate some type of income or revenue. Even if you weren't able to actually have a net income, it was still generating you revenue. And now look at that, that property is probably worth $350,000 now, right? Like, I mean, it is just probably way grown in value. Sorry.
Yeah.
So the risk though of real estate are real. It's just not the same as the traditional 401k. Because like you said, it could be the market, it can be the downturn. You don't have that control, shelter, basic need. But walk us through, like, what are the real estate risks?
Yeah. So we're broken them out in multiple categories. So the first is property risk, right? A lot of investors, when they say to me, like, "Hey, why are you on the phone with me?" They're like, I want passive income. I want to, create a financial legacy for my family. I want to retire sooner. I want to supplement my retirement. Fill in the blank. It's all the same. It's always comes down to the same 5 things, right? And so, and then I'm like, well, what's your fear? What are you scared of? Oh, I don't want to lose money. Everyone says that. I'm an investor too, and I don't want to lose money, right? So, but there are risks, right? And there's things that we do at Spartan to mitigate the risk. But here are some examples of some property risks, right? Your HVAC goes out. That's a $5,000 to $8,000 bill. Your roof replacement. I had to replace the roof once. It was $12,000, right? It happens, but the property's paid off. It's been generating me lots of money, so I'm okay. I write the check. It's all done. It's good. You're moving on. Right? Unexpected repairs. It happens. Like, think about this, guys. You have the houses that you're in now. There's probably things, there's your honey-do list that you haven't gotten to yet that are maintenance things that need to be done around your house. It's the same thing with the rental property. You just got to keep proper maintenance on it, right? You keep proper maintenance on it, and you can avoid some of these unexpected large repair bills with proper maintenance. So that's one risk bucket. The other one is tenant risk, right? We're relying on people to actually do what they're going to do. And sometimes they don't do that. So we can have, we actually have an internal little statement: people are people. Like, we just can't control people. There's a lot of things that we can do all the way up until they move into that property. We can verify them, do the background check, criminal history check, verify their income, blah, 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 blah. Everything checks out. And then what the hell happens afterwards? I don't know, right? It could go sideways. Divorce, disease, breakups, transfers, it's life, right? But we just adapt. So vacancy, missed or late payments, property damage from the tenant, market risks, rent softens in areas, can happen. Temporary oversupply, remember the keyword temporary, and then local economic shifts. Things happen. Look at Detroit, look at GM, global financial meltdown. That was a big deal. It was a big local economic shift, seismic. And then the financial risk, interest rates change, you over leverage yourself, cash flows are on the deal, right? So you make like you get a little money out of pocket. So those are the risks that you see.
And I know we only have about like 10 more minutes, and I want to get to a couple of other points. Yep. We've done our tale of two investors, and we've shown them side by side and shown that comparison. And I do want to touch on that it's not one or the other. Right. Like, I think that the takeaway here is that we need to get back to 401ks being the supplement. We don't necessarily need to rely only on this particular method.
I agree with you. And I think like somewhere along the line, I don't know what marketing director was like, let's just sell this as like the primary plan. Probably some corporate owners who were like, we're tired of paying these pensions. Let's put some marketing dollars towards the 401k and fool everybody. Mm-hmm. Right. And that's how I know it to be true, you guys, because I've lived through, born in 1970, The first 401k was 1981. I talked to the majority of people in their 40s, 50s, and 60s, my age, that are like, yeah, that didn't quite work out like I thought it was going to, right? So it's not one or the other, it is both. But just set yourself up for success. And this is how you do it. So this is why doing both is powerful. They solve different problems. One, the 401k, long-term growth, check, right? Real estate, current income, we need cash, check. Together, one builds the future, one funds your life on the daily. Love that. Number two, it reduces your timing risk, right? Stocks, timing dependent. Real estate, income producing. If the market drops, you're not forced to sell and your lifestyle is still supported. Thank you, renter, for giving us that money. We love it. You unlock extra capital channels, right? 401k is capped. They're like, you can only put so much money in and then you're done, tapped out. With real estate, not capped. You can buy as much as you want. Nobody cares as long as you got the capital to do it. Keep going, right? And you can scale with savings, leverage, or equity. Cash out, refinance, buy, rinse, repeat, do it again, build your portfolio. Income can fuel your growth. This is you. Don't miss this. Real estate can. Cash flow. It funds more investments, offsets living expenses. Who would like someone else to pay your bills for you every single month? I would. And allow you to invest more aggressively elsewhere. You don't have to invest in your backyard. You can find cheaper, lower barrier of entry markets with really good salespeople that help you manage it. Just saying. And it creates balance. So your stocks, they're liquid and they're passive. Real estate's stable, income driven. So doing both together is really complementary.
Yeah, absolutely. And again, yeah, we're not telling everyone that's like, hey, don't listen to your wealth advisor and don't invest in a 401k. Like, you can do both. Imagine if you did both strategies, if you did the 10,000, if you did the gray and the green, and you were able to put back that much money and still invest in the 401k and then still be able to take all of your discretionary income and then put it back to start buying real estate. Just imagine what your portfolio looks like at 60 then by doing both. So one thing that I want you to touch on though is we've talked about the risk of real estate, but we've also painted it in an absolutely beautiful light, which again, I'm an investor. I think it is in a beautiful light. But why doesn't everybody do this? Why doesn't everybody own 5 properties by the time they're 41? Why doesn't everybody have 10 property portfolio by the time they're 60? Why doesn't everybody do it?
Such an amazing question. And it's really just, there's a lot of friction points. People just don't really know where to start, who to trust, what market, what's a good deal? Is this a good zip code? Should I trust this person? What's a good property management company? Do I need to find a realtor and find the house myself? How about a contractor? I've heard about nightmare stories about contractors running off with my money, or someone else's money. And they almost, it's like, there's so many points of friction that they're like, no, I'm just gonna stick with the 401k. That's easy, right? The path of least resistance. The path of least resistance. But the path of least resistance does not lead to high net worth and cash flow. Might get you the high net worth. It's not going to get you the monthly cash flow. And that's what we want for you guys, right? So yeah, I guess, I wasn't even reading the list. I was just thinking about all the friction points. There might be some things on here that I missed. Financing. Maybe someone's never bought a house before. I've actually working with a couple up in LA. They're renters, but they've got capital they want to buy. They can't buy, $1.1 million fixer-upper in LA, and they're looking at new construction in Alabama, right? But they don't even know what a mortgage is. I had to explain to them what a mortgage is, so maybe that's intimidating, right? They don't know how to scale. Yeah, so there's a lot.
You're absolutely right. Like if you're looking at these numbers and you're like, well, real estate is clearly the better option, and then you go and there's, I don't know, 10,000 podcasts out there on how to grow your portfolio with real estate. There's probably double that number of books on Amazon to purchase to figure out how to do it, how you buy the property, how you rent the property, how you manage the property, how do you not have a contractor walk away with all of your money, which has happened to Spartan. I don't even know how many times. Like, how do you do all of this it can be very overwhelming. So if you are younger and you have those two options, and you can literally just sign up to start having money withdrawn from your payroll, like from your income, to go into a 401k versus saving to take this path, you're absolutely right in that this is overwhelming. And it genuinely can be.
Yeah, really, really good point. And I'll support what you just said, because there are so many investors that I've talked to that I'm like, how long have you been considering real estate? Well, I've been studying it for 6 years. I've been researching this for 5 years.
I hear that all the time.
And they've never done anything. They haven't done anything in real estate except for read about real estate, right? And so I'm like, okay, now now that's the fear, right? It's just helping them get over the fear, and everything you want. Tony Robbins taught me, everything that you want is on the opposite of everything that you fear. That's why I walked on fire. I got to the other side. I climbed a 40-foot telephone pole and jumped off and grabbed a trapeze bar, right? It's all about breaking down your fears and limiting beliefs so that you know that you can do something that is going to be fantastic financially for you and your family. Just have to have the courage to do it and align yourself with the right people to be able to help you get to that goal. Okay, so where strategy meets execution. We're wrapping it up here. I got 4 minutes. I got to talk fast. My jersey's coming out. Here we go. All right, we remove complexity. So what does Spartan do? You don't have to find the deals. We find them, right? You don't have to analyze the markets. Although I have people that love to analyze, my little engineers. You just love to analyze the numbers all day long, and I'm okay with that because I love sparring with you about it. It's fun. You don't have to guess. We took all the guesswork out of it. We removed all the complexity for you because our team has done it all. We handle the execution. You don't have to find the contractor. You don't have to hire a project manager. Or you don't have to oversee the construction. Nick Smelter does that for us. Love that guy. So our renovation and our construction, you get a stabilized, rent-ready, fully rehabbed, new roof, new HVAC, new water heater, new flooring, new countertops, blah, 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 sexy Corian, granite. It all looks great, right? Systems are already in place. That's why we call it turnkey, right? When Lindsay, Clayton, and I, when we thought about starting this business, actually they kind of started it and I joined. They invited me in. Thank you. I very appreciate that. They had these systems in place, and Lindsay has only refined them over and over and over again. Because the one thing that you don't know about her that I will tell you on this call, she is an operator, a systems, processes person, right? So she took the vision of Clayton, she put it into systems and processes and people, and she manages it every 5 business days, looking at all the metrics, and there's always a new metric popping up, because she's like, how can we get better? How can we tweak this? Right? I was like, another metric? Oh my God, here we go. But I love it, right? We manage the asset, right? So we remove the complexity, we handle the execution, we manage the asset. There's no leasing, there's no calls coming to you about problems. We handle all that. We take care of all that. We do all the maintenance coordination. And then lastly, we think like investors because we are investors, right? We're not selling houses. We're selling futures.
Yep.
Financial futures secured with the asset from the ancient Romans. You will have wealth with real estate. The Romans knew it. We know it.
Yep. And again, when we were discussing this, Maureen, she's like, "Hey, I'm a visual person, so let's put it up like this is essentially what we're doing, right? We're purchasing the properties, we're renovating them, renting them, and then you get the monthly income." And that's why we have jobs. That is what we do day in and day out. She's absolutely right in that we're both investors, and we both fully believe in that. And I am also a product of, I contribute to a 401k, and I also purchase rental properties and grow my rental portfolio. I'm doing both. I'm checking both boxes. And so we just strongly encourage everyone to do that exact same thing. And if you want to hear more about what we do, what markets we're in, we'd love to schedule a call with you. If you want to scan this QR code and you can get in touch with us, you will have access to all of the information all of our contact once since you've signed up for this workshop. But just very high level. Right now, we manage 2,300 doors. We have 93 employees. We've been in business for almost 20 years. And we have also been on the Inc. 5000 fastest growing companies for 8 consecutive years. So we have just a plethora of experience and knowledge in this area. And so we'd love to talk to you more. So feel free to reach out to us. Maureen, thank you so much. We ended right at 1:00. Crushed it. Absolutely crushed it.
Yes. Go team. Thank you guys so much for coming. Really appreciate your attention, and keep investing in yourselves and your education. Keep pursuing real estate. Even if it's not with us, keep doing it. It is the roadmap to wealth. Listen to the Romans.
Love it. Thank you guys so much.
Bye.